Hi, I'm John Persinos, Editorial Director of Investing Daily. Amid this volatile bear market, I figured now is a good time to tap the expertise of one of the shrewdest investors I know, Robert Rapier. He's Chief Investment Strategist of Utility Forecaster, Rapier's Income Accelerator, and Income Forecaster. Robert is a prolific writer. His articles have appeared in The Washington Post, The Wall Street Journal, Forbes magazine, and he's been a featured expert on 60 Minutes and the History Channel. Robert, thanks for being here today. I know you're a busy guy.
Thanks for having me on, John. Looking forward to our conversation here.
Me too. Let's get right to it. The Federal Reserve just hiked interest rates by 75 basis points, 0.75%. The markets tanked in response. Do you think that there's any chance that the stock market can end in positive territory by the end of 2022?
I would say probably not. I mean, at this point, we were looking pretty good coming into the second half of the year. We started a rally in the second half of June. And then Powell came out with some pretty negative comments regarding, inflation and what they were going to have to do with respect to interest rates. And so that caused the market to start selling off in July. I just checked, the S&P 500 is now back down more than 20% year to date. So we're still very firmly in a bear market. He recently made some more negative comments where it doesn't sound like, that we see the light at the end of the tunnel just yet.
What's interesting to me is that the 0.75% interest rate hike was widely anticipated. It was no surprise. And I recall on that day that after the FOMC made their announcement at 2 p.m., the markets were in the green. And then at 2:30, Powell got behind the lectern and started talking, and you saw the markets tank in real time. And his comments to me sounded confusing, rather contradictory, and very negative. Do you sometimes get the impression that Jerome Powell talks down the markets and perhaps we should get less chatter from the Federal Reserve and Powell?
Yeah, for sure. I mean, you're right. The 75 basis point hike was anticipated. I don't think what was anticipated was the negative comments going forward and about all the pain that we're going to experience. Right. I mean, he's signaling that, there's more hikes ahead. And I think that's premature. I think they've got to see, where inflation is going to settle out here. Inflation has started to cool off a little bit. I think you've got to really kind of wait and see what's happening before you go and say, hey, we got more interest rate hikes teed up here.
Yeah, and not to sound Pollyannish, but there are some signs that inflation has peaked. The PPI has come down. Ocean shipping rates have come down. Gasoline prices have certainly plunged.
Right.
So when do you think the Federal Reserve will start to ease up on interest rates? I mean, the hoped for dovish pivot, that's dead for this year, obviously, but sometime next year, do you expect the Fed to ease up?
I do, because I expect inflation is going to settle down here. I mean, I always look to energy prices.
Right.
They're a major driver of inflation, and they are settling down now. The oil prices have pulled back a lot. Gasoline prices have pulled back. That's definitely helped with inflation. And I think we got to look, 6 months from now and see where things stand. I would anticipate these interest rate hikes would stop or certainly slow down a lot next year.
It sometimes occurs to me that perhaps the Fed is fighting the wrong war because inflation right now is largely the result of the Russia-Ukraine war, the havoc it's wreaking with supply chains, what it's done to energy prices, and interest rates can't address those concerns. Do you sometimes get the feeling that the Fed will cause gratuitous damage to the economy?
Yes, I do. I mean, you're absolutely right. I mean, if you look at the roots of why inflation has soared, it is energy prices. And, energy often drives inflation. It's doing it right now. And certainly Russia's invasion of Ukraine helped drive gasoline price up very high. So that, and you're right, interest rate hikes won't do anything to help that.
Right.
Now, we do have a hot economy. We do have, very strong job growth and low unemployment, and it will help slow things down there. But, the primary reason we had such soaring inflation was the energy markets. Wasn't the only reason, but it was a big, big factor, and interest rates aren't going to help much there.
It's interesting to me that another hopeful sign in inflation is that the consumer expectations of inflation are coming down, and it's expectations that can become entrenched, and inflation becomes a self-fulfilling prophecy. But those expectations are improving in regards to inflation, largely because gas prices are coming down. And as someone in the publishing industry, it's interesting to me how the financial media emphasizes negative news, that when gas prices were soaring, that led all the newscasts, and now that they've plunged, you hardly hear about gas prices anymore. Has that occurred to you as well?
Yeah, I mean, that's always the case. It's always consumers wonder. Consumers always wonder why gas prices will shoot up like crazy and then drift down very slowly, and it's all embedded in consumer behavior. We don't like to pay more when things are going up, but when things are going down, we're so relieved that we just don't do a lot of comparison shopping. There's actually studies that show that, and I think it's the same way with the news. Prices are going down. Okay, it's not such a big deal as it was when they were going up.
Yeah, and of course, rising gas prices were emphasized for partisan reasons because we have the midterm elections coming up. In terms of investment risks, what do you think are some of the worst dangers bedeviling investors right now, in your view?
So I think we have to be very careful that just because a stock has sold off a lot that, it's a bargain, because earnings have contracted in a lot of industries. So we still have to look at, things like earnings and cash flow and what's really going on in the business. A company may be off by 50%, but earnings are down by 75. That doesn't necessarily mean the company's a good buy. And, that old maxim, buy when there's blood in the street. I always offer a corollary to that. There can always be more blood.
Right.
You don't know when the bleeding has stopped until, it's in the rearview mirror.
Yeah, that's right. Look at the way the summer rally has fizzled out. Goldman Sachs just came out with a prediction that the S&P will finish will drop another 4% before the year is out. So there are opportunities in sell-offs. You can think about buying some of the stocks on your wish list that are now bargains, so to speak. But there's the old adage: don't try to catch a falling knife. So
right.
The caution is called for. Inflation obviously remains the big investment story. What are some of your favorite inflation hedges?
So I always tell people that my favorite inflation hedge is always the energy sector. And there's a simple reason for that. Energy often drives inflation. If you see soaring oil prices, inflation's going up. And so inflation going up, soaring energy prices, but that also drives energy company profits. So, the energy sector, we've had soaring inflation this year. Which sector has done very, very well? The energy sector. It's the only S&P 500 sector that's up double digits year to date. Utilities are up slightly the last time I checked, but those are the only two sectors that are in the black this year. The other sectors are all down, but the energy sector, people get kind of cause and effect mixed up. I've seen people blame inflation on soaring energy profits, but it's the reverse. It's inflation that drives those profits, and that's why energy is my favorite inflation hedge.
Yeah, you're hearing a lot of frankly, demagoguery about energy profits. It's somehow that's driving inflation, but it doesn't work that way. Robert, utility stocks are your forte. What's your outlook for the utility sector in 2023?
Yeah, I think utilities will continue to do well. There's a reason that they performed decently in this bear market this year. Historically, they always do well in a recession. I expect us, if we're not in a recession, we're close. We have some indications that we may be in a recession. And in this kind of climate, utilities will do well. And I think it's smart to have some of your money allocated into utilities during this climate and through next year. And, a lot of the individual utilities that I cover, if you look, they have substantially, they're up, some of them are up double digits year to date. The sector itself has done okay. People, even in a recession, even in inflationary times, they still are going to pay their utilities. So these are largely recession-resistant sectors.
Robert, you rely on an investment method that generates steady income regardless of market ups and downs, regardless of Fed policy or Jerome Powell's pronouncements. How does this all-weather investment technique work?
So I'm looking for sustainable dividend payers over time. And, there are dividend payers that have raised their dividend for every year for decades. And I'm looking for those kind of companies. I'm looking for companies that have generated cash flow across up and down markets. And so that's the starting point. Starting point is a good, steady dividend payer. But then I'm looking to supplement that dividend by selling covered calls on those companies. And what that means is I'm selling an option to someone who has the right then to buy my shares at some future time. And I'm targeting 8% yields. And I manage that in the portfolios that my model portfolios, they all have 8% overall yields when the covered call is considered. Now, what is the risk? The risk is that your gains are capped. The risk is, your shares are trading at 100, you sell a covered call at 120. At some future time, the shares are at 130, you still have to sell them at 120. So it's really not downside risk that you're experiencing. It's you're taking sure money in hand, and with that, you're capping your potential gains. Most of the time, it works out. I mean, this strategy, there have been studies that have shown that in nearly all markets, this strategy does outperform the market.
You're obviously very adept at trading options, but some investors, in fact, many investors, are intimidated by options. They think they're too risky, they're too complex. Explain to us why options trading is suitable for all types of investors, even those who are risk averse.
Sure. So buying options is certainly risky. And studies have shown that most people who buy options lose money. It's more akin to gambling. And I tell people in that case, if most people that buy options are losing money, be the person who sells options. I mean, you can sell options on shares that you have. And then, if we use a Vegas analogy, you're now the house. You're operating as the house. Over time, you may have to pay out, but you're going to collect these premiums over time. And for those gamblers who are losing money over time, you're making money at their expense. So be the house, collect that income stream. Understand every now and then you're going to have to pay out. You're going to lose your shares when you would have liked to have kept them. But over time, you're going to add a few percentage points onto your returns. And, those compound returns over a period of a long time are going to really add up for you.
Robert, thanks for your time. As usual, you provided useful insights for retail investors.
Thanks, John. It's great seeing you again.
Yeah, same here. As my colleague Robert Rapier just explained, there are investing methods that work regardless of market gyrations, that work in bull and bear markets, in recessions or expansions. You should know that Investing Daily has just launched a brand new service helmed by Robert Rapier. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, thanks for watching. Stay invested and stay safe.